Welcome, ladies and gentlemen, from me, Guy Monson, to our regular 6-minute strategy summary. I'm going to look this week at the odd behaviour of world bond markets, the so-called engine room of the financial system. Why are bond yields falling and prices rising just as inflation is hotting up and growth estimates are being lifted around the world? We've just lifted our GDP numbers to plus 6.1%, a blistering number for 2021. It's odd also against the backdrop of inflation. We're seeing pricing pressures across the global supply chain. We're seeing in commodities new record highs for oil prices. And of course, we're seeing it in the headline numbers, the US CPI touching 5%. What's behind this, and particularly behind the extraordinarily strong flows that we've seen into bond funds, almost double the flows into equity funds for this year to date? We'll be answering this question asking what does it mean for world growth, what does it mean for financial markets, what action should you be taking in your portfolios? So let's look briefly at the performance of bonds in the left-hand panel. You can see the yield on the US 10-year Treasury falling back down to 1.3, as we talked about earlier, and the yield on the UK gilt falling back to 0.7, this extraordinary rally that was so unexpected in bond prices. That means, of course, that with falling bond yields but rising inflation, real yields are seriously unattractive. A 10-year BBB rated bond, the sort of thing you might see issued by British Telecom or the supermarkets here in the UK, yielding just 0.2% in real terms. The 10-year gilt yielding minus 1.2%. 3-month money yielding minus 2%. So why with these highly unattractive real yields is money pouring into bond funds around the world? Well, I think there's 3 possible answers. The first one, of course, is the central banks are still huge buyers. And you can see those ballooning central bank balance sheets on the left-hand panel. And of course, they'll buy more. Even with taper, which we expect Mr. Powell at the Federal Reserve to ease his bond purchases at the end of this year and early next year, we're still looking at 1 trillion or more of bond purchase for both the Federal Reserve and the ECB under Madame Lagarde in the 12 months ahead. At the same time, though, government issuance is thankfully beginning to fall as the world recovery and reopening allows tax revenues to improve. You can see this graphically for the UK. In yellow, we're expecting a borrowing requirement of 91 billion for 2020-2021. That falls to 53 billion for this tax year. And as you can see for those black bars for April and May, actually we're coming in month by month on even better numbers still. So strong demand from the central banks meets better financing requirements or lower financing requirements from central governments. The second reason I think the bonds are rallying is the inflation data is perhaps peaking. It's probably too early to say, but 5-year forward inflation expectations, which we've looked at, that's the market-derived rate for US inflation, beginning to roll over to 2.17. Commodity prices, as a particularly food-heavy index, beginning to flatline, albeit at a high level. And the ISM prices paid, this is the cost for manufacturing companies at the factory gate, commodities, input cost, steel, are beginning to ease a little bit from the extremely high levels we've seen. Now this will take some time to flow through into the headline rates, the UK CPI at 2.1% and the US CPI at a blistering 5%, but perhaps the worst might be behind us. The third reason I think bonds are rallied is people are expecting slower economic growth going forward, or at least marginally slower growth, because of the Delta variant and the possibility this might delay the reopening of world economies. I've dug out from some of our earlier presentations the COVID Global Stringency Index. If you remember, 100 is full lockdown, 0 is the position pre the crisis. And you can see that countries are still only quite slowly beginning to ease. The US, the most liberal, at 33.8. The UK in blue at 51.4. That will fall sharply when the remaining restriction measures fall away on the 19th. But Germany and much of Europe still being extremely cautious. And this is meaning that mobility data and the ability of people to move is still quite restricted. On the right-hand side, you can see transit station visits. This is monitoring the behaviour of people around stations across the UK at minus 28% below the level it was pre-crisis. So there's a feeling, I think, that the rate of recovery might slow. Put all these together and perhaps you have a reason for this sharp rally in bonds. Now, we don't expect it to continue. If anything, we expect yields to start to rise again. But it has changed the dynamic for world financial markets. First of all, it's supported global equities even further. And you can see on the left-hand panel that world equities are now up 11% for a UK investor. Extraordinary. On the bottom of the panel there, you can see UK gilts begin to rally. But remember, you're still looking at losses for the year. Most importantly, though, lower bond yields mean a more attractive environment for growth stocks, where the returns only come to you over the long term. And that's allowed the growth stocks, the tech stocks, to really rally sharply, almost catching up with the World Value Index for the year to date. So the stock market has become a lot more balanced. Finally, at the bottom, equity volatility remains pleasingly low, and that's again supported by underlying bond yields. So what does this mean? Well, this, I'm afraid, still argues to us that it is dangerous at these yields to be too attractive to the bond markets. Real yields are just too low. So we are remaining with a strongly underweight position. In equities, we continue to be overweight, supported by the low real yields in other asset classes. And we'd much rather that you put some of that bond money into alternatives, renewables and infrastructure, where you get a much higher inflation plus premium. So I hope that's helpful, looking at that odd issue of why are bond markets rallying just when world growth and world inflation are starting to accelerate. I hope that was useful. Thank you so much.